Let's calculate the intrinsic value of Goodyear tire. Now, in order to do this, we need to estimate the future free cash flow of the company, discount it back to today's dollars, and then divide that number by the number of shares outstanding. So let's get started. What's their market cap? 1.66 billion. So 1.66 billion and 714 a share. 232 million shares outstanding. So now let's look at their financials. And the free cash flow is how an analyst figures out the future value of a company. What they do is they look at prior free cash flow and then extrapolate it based on net income, revenue, and some other numbers. Everybody has their own model. They're all fairly similar, but this is my model, and I've fine-tuned it over the years. So let's pull their free cash for the last 4 years. And they have positive free cash flow, which is a good sign. Now let's see their net income. Net income. See, in 2019, they had a negative net income. They had negative net income, but a positive free cash flow. So when I used to look at stocks in the beginning, I used to look at the income statement and see if they had positive net income, and I would consider it a good buy. Like in 2016, this company has 1.3 billion of net income, so I think that's that's good. And then it dropped off a lot, but it's positive, but it hits a negative here. But net income isn't always the best indicator of how a company's doing. It's just one indicator. Free cash flow is the actual cash that goes in and out of the business after operations. It's kind of what's left over for the owners, in our case, the investors. But if you bought the company, bought this entire company, the free cash flow will be what's left over for you. So it could be confusing to some people. They may say, how come it's so different? Let me give you just a quick example. So if a company like Goodyear bought a building as a new factory, right? Say it was this year, they had a low free cash flow. Say it cost $500 million for the building, and their free cash flow went down $500 million to $100 million. Now, that $500 million doesn't go onto the income statement, because you'll never see like building on the income statement. What happens is it goes onto the balance sheet, and then they depreciate it. So 500 goes onto the balance sheet, and then they may depreciate over 10 years, because they may say the building will last 10 years before the value is nothing. So every year they record an expense of 50 million on the income statement. So you're only seeing 50 million each year. And the remaining balance stays on the balance sheet until it's totally depreciated down. So understanding accounting is a big part of investing in a company. So as you can see, they have pretty steady revenue, although it has been it did decline last year. So that's not a positive sign, but it's fairly steady, which is good. Now let's look at the capital structure. Let's see how much we have to discount the free cash flows by. Because every company has their own unique capital structure, and they borrow at all different rates. So let's see what they borrow at. So let's see what their liabilities are. Their short-term liabilities are 910 million. That's the liabilities due within 12 months. And the long-term liabilities are 4.8 million. And that's due beyond 12 months. So they pay a pretty hefty interest rate of 6% on the debt. Now we have to deduct the taxes. So let's see what the tax rate is. Income before tax. See, this is what I'm saying is, look at the income before tax, 177 million, and look at the taxes. They pay more taxes than they actually made, which doesn't look like that could be possible, right? You don't pay more taxes than you make. But with a lot of accounting things going on and depreciation, and these companies use accrual accounting, which means when cash comes in, they don't apply it that year. They apply it when transactions occur or when they receive the product, or it could be over a 10-year period they apply the cash. So that's why things are a little funky. Let's use the prior year. That's more seems more accurate. So the income before tax is $1 billion, and the income tax is in 2018 with 300 million. Because effective income tax should be pretty similar year to year. So they pay 30% on their income, 30% taxes. So that 6% is reduced to 4.2%. That's the cost of debt, 4.2%. Now let's see the cost of equity. Now we need to find the beta, which is the volatility of the stock, and it's pretty high, 2.02. So that means the stock moves twice as much as the market. So equity is always more expensive than debt because it's lower in a capital structure. So 18% the cost of equity, 4% the cost of debt. When you blend those together, you get 7.29%. And the way we blend it is based on the weight of debt and weight of equity. They're a very highly indebted company, which is not necessarily a great sign, especially during coronavirus when it may be harder to borrow. So let's apply that WACC to the future free cash flows. And these are the cash flows we calculated based off of their actual numbers. And when we discount it back to today's numbers, we get a total of $2.7 billion. That's the value of the company today, according to their financials and according to my model. And now if we divide that number by 232 million, we get an intrinsic value of $11.79 per share, which is a good sign because they're trading at $7.14. So they're trading at a 39% discount. Now, if you look in prior years, they were trading at intrinsic and even a premium to intrinsic for a while. But why are they trading below intrinsic value, you may ask? Well, people don't feel the future of the company is worth $11.79, especially during this time of coronavirus. Investors may feel the stock will go down, their revenues will go down, their expenses may go up, and that's why they feel the stock is not worth what it is. But that's up to you. That's your analysis, and this is mine, and this is how my model perceived it. Of course, if I was investing, I would probably look into more things like the 10K and their competitors, things like that. But what would you do? Let me know in the comments how you feel about these results and how you would analyze this company. Thanks for watching.